U.S. depositors are on the edge of their seats as a banking crisis has emerged in that country. So far, 3 banks have shut their doors with fears of more to do the same. As steep sell-offs are now occurring in the U.S. stock market, the crisis has now spread overseas. Shares in Swiss banking giant Credit Suisse has hit a new low. What are the implications of this crisis? Whatever happened to the U.S. President Joe Biden assuring people not to worry? And is this just a banking crisis, or is this a reflection of deep economic ruptures, especially in the U.S. economy? First, let me introduce our guest for this edition of The Spotlight. John Edmonds, professor of finance at Babson College Wellesley in Wellesley, Mass., joins us. Also joining us is Peter Koenig, former World Bank economist, who joins us from Lima over in Peru. Gentlemen, welcome to you both. John Edmonds, I'll first start with you. And this is a general question as to see where you stand on this banking crisis, where it's now deepening, obviously, and we're looking at banks, other banks that are feeling the heat, and U.S. stock markets are not doing well. What are we looking at here, John Edmonds?
It's a specific failure of a bank that invested the money coming in a way which was riskier than it should have been, and then they didn't do hedging. It's not the first part of a massive systemic financial crisis like what we had in 2008, 2009. That was a completely different story.
What makes you so sure that it's not a beginning of a wider problem?
Well, it is a wider problem, but what it's doing is it's putting the spotlight on every bank in the world that isn't doing very well. The bad boy of the moment is Credit Suisse, but they do not have any problem with a maturity mismatch in their bond portfolio. They don't have any massive increase in non-performing loans. What they don't have is they don't have a long-term way of making a profit. Their costs are too high, their revenue is too low, and that's not new. So that stock had been getting hit for a long time. The answer of the Saudis was baked in. They should have known what they were going to be told, because the Saudis couldn't go over 10% ownership of the shares, or it would trigger other factors, other regulatory issues that they didn't want to deal with. And I think also what they really need to do, what Credit Suisse needs to do, is downsize. They've been doing it for years, but they don't seem to be able to do it fast enough.
Peter Koenig, you heard our guest there. Do you agree with what he said?
Sorry? I didn't get your question.
You heard some of the statements there made by our guest there. Do you agree with the way that he described the situation regarding the banking sector in the U.S.? Do you agree with him?
Yes and no. I would like to add something which so far nobody has actually made the connection to. I think this could be a potential systemic crisis which goes far beyond the 2008-2010 crisis, because so far nobody has really officially made the connection to the World Economic Forum, which has said already a long time ago, and it's mentioned in the Great Reset, that there will be a banking crisis. And how do they do that? I mean, it's playing out in front of our eyes, and we can't see it, or we don't want to see it. Behind this banking crisis that has been building up for a long time, behind this banking crisis is an internal crisis of derivatives. You know, these banks, especially the big banks, the so-called systemic banks, big banks, they used to be called too big to fail. They have enormous amounts of outstanding derivatives, which are not really money. That's casino money. It's the money that has never been created. It's created just by speculation, and by fast speculation only by financial institutions and banks. So estimates of outstanding, nobody knows exactly how much is outstanding, but estimates range from between 500 trillion to over $2 quadrillion in derivatives outstanding by the biggest banks, and you know, I'm talking about, not even talking about BlackRock, Vanguard, and State Street, but mostly those that are listed and working with Wall Street, like Citibank, Bank of America, Chase, Morgan, and so on. Those have enormous amounts of outstanding. You can imagine what that means. If somebody talks about that, it creates a crisis immediately. and people are going to be afraid.
Okay.
And we know what the media can do these days. So I think this is part of the reason that this crisis is being generated now.
All right. Before I move on to John Edmonds to get a reaction, can you tell us what the WEF warning was?
Well, this is not new.
John Edmonds, hold on. Let me get. Okay. Well, why don't you go ahead? This is the warning that I looked up, and it said governments have leveraged cheap money to invest in future growth and to help stabilize distressed financial systems. And our guest there talks about an exorbitant amount of money. What do you think?
Well, yes, I agree with the previous expert. I thought he was also going to mention the exposure to emerging markets, which are always vulnerable to any situation like this. Specifically with regard to derivatives, the figure that was tossed around years ago was 600 trillion face value of derivatives, and just for reference, that would be maybe 5 times the value of annual output in the world. But most of the derivatives are for other purposes, or they're supposed to be actually reducing risk. This is the mistake that the Silicon Valley Bank didn't hedge. They bought long-term bonds and then did not sell them for a future delivery. So you could say their specific problem was not enough derivatives or not the right ones. But you're quite right that the derivatives are really kind of hidden from view most of the time because of the way they're reported. So you could argue that the precarious nature of the entire world financial system is once again on display. Most of the entities in it have adequate protection, and they also have backing from their government. But we have a bigger threat coming on, which is the House of Representatives might not raise the debt ceiling for the U.S. Treasury, in which case, probably in June or July, the U.S. Treasury would be actually unable to pay bonds that were being presented for redeeming. When a bond matures, you can deliver it to the Treasury, and they're supposed to give you cash, but they wouldn't be able to do that.
Okay, perhaps that speaks to the wider U.S. economy there. But let's rewind a little bit here, Peter Koenig. On the one hand, you have this Silicon Valley Bank that made the announcement on a Wednesday, and by Saturday, the bank's doors were shut and the announcement was made. And on the other hand, you have the way that this is being reported, and we're going by the way that various news outlets are reporting this, that you have stocks that are in sell-off mode, but this is the part that's most important, that there are worries that more lenders could fail. How is it that you have institutions, organizations that are supposed to monitor this, like the SEC in the US and others, and yet you have these bank failures that are showing up the way they do, especially at warp speed, may I add, in the case of SVB? I mean, aren't they supposed to be monitoring this? And how could they not know that other banks are in distress unless they don't want to make that announcement yet, because it would obviously lead to more public outrage and worry, and obviously that could spell, for example, a run on the banks?
Well, right. I mean, the point is that they do know. It's not that they don't know, but the government knows, and the so-called regulatory agencies, which there are practically none anymore for the banking sector, they are aware of the risk, and they are purposefully, they don't do anything. And why? I mean, the banking sector has been largely deregulated by the Clinton administration in 1999. This has been then a big scandal and has made the round in the media, but in the meantime has been forgotten. Nothing has changed. The banking, particularly as far as derivatives concerned, is still totally deregulated. So the banks can do whatever they want. They can lend and borrow whatever they want. They don't have a ceiling anymore. They used to have ceilings. This is all gone. And now comes the fact that we also have to mention, because there are many dimensions to this, the Federal Reserve has, within the last half a year or so, has rapidly increased interest rates to levels which has not been seen during the last 3 decades at least. You know, and that has made banks insecure, has lenders made insecure, businesses also, of course, so they became very much scared of borrowing money. And this has contributed also to a contraction of the banking sector. On the other hand, the interest rates, the increase of interest rates have brought a shock
Sure.
in not only to the banking sector as a whole, but only to business, and so they have become very much cautious on what they're gonna do in the future. Now, why is the banking sector not being regulated? I mean, it's almost totally deregulated, and there are parts of the banking sector which should be at least regulated or abandoned altogether. Like I find the casino money play, the
Sure.
games with derivatives should be stopped or at least regulated. But there's such a strong lobbying from the big financial institutions with Congress that this hasn't happened and doesn't happen probably within the foreseeable future until a catastrophe will happen. And so these are additional facts that need to be added into this potential crisis.
Sure. John Edmonds, let's talk about these interest rate topic here, because what we're looking at is both SVB and Signature Bank. That's another bank that went bankrupt. They were actually, from what the report says, they were overly exposed to assets whose values came under pressure from rising interest rates. Tell us how that leads to the banks closing down. What it means.
Well, let me just describe bank regulation as it was classically imposed at the end of the 1980s. A bank is supposed to have stockholders' equity equal to or greater than 8% of risky assets, and their bonds are not supposed to be risky. But what happened was those banks bought long-term fixed-rate bonds, which then declined in value because of the rising interest rates. So instead of their loan portfolio being a source of headaches, it was their bond portfolio, and suddenly they found themselves in a situation where, by operation of rules, they would have to be liquidated. But the point about derivatives that the other person is mentioning is entirely correct. As say, they were supposed to be regulated in the Dodd-Frank law, and the documents that were floating around after that were not really decisive. So it's possible, if you're clever, to circumvent the regulation and take advantage of the very low-cost money. The other relevant point is that interest rates were very low in Japan from 1990 onward, and in the rest of the world from the year 2000 onward, and especially from 2008 onward. So bankers lived there pretty much their entire career in a very low interest rate environment, and they were expecting that the low interest rates would continue. So they took in deposits on which they were offering to pay very low interest rates, and then they invested the money in something that was supposed to yield more, which it would do, except that then when interest rates went up, their cost of money went up and their return on portfolio went down. So they were still getting the coupon payments from these bonds, but they suffered a capital loss on the bonds, and that was fatal for at least two of them.
Okay, so let's try to break that down. Peter Koenig, what our guest there said. If I was somebody watching this, I might be a little confused, but let me see if this makes sense, whether I'm right in looking at it this way, because maybe some viewers might also look at it this way. So you have the bank, they took in the money from an average person, and they took that money and they invested it in something else, but because the interest rates on the money rose, the bank was not able to make the money back in terms of the ratio or the percentage that it wanted to, and it fell short in terms of giving the money back to the customer?
If you take in money from a depositor and tell them you're going to pay them 1%, and then you take that money and invest it in something that's supposed to yield 4%, that's 4% isn't really high enough to cover the bank's costs of salary and overhead and things like that. But suppose that we just talk about 4% and 1%, they should be making 3%. But what happens on that is they couldn't consistently make enough on the money that they were lending out, and so they went to other things which were maybe more speculative, and that will come out soon. But
So
if you're,
and how long has this been going on, you think?
Well, it's been going on for quite a long while since after Dodd-Frank, which was in 2010. There was supposed to be a regulation about derivatives, and they tossed that back and forth. And I only followed it for a while, but every 6 months
But
they
the
came out
interest
with a
rates
new
have been
draft.
going up for the past year, haven't they?
Well, yeah, but I mean,
Exactly.
with regard to the accounting for derivatives and
Okay,
regulating the
let me
bank
get Peter
derivatives
Koenig
business,
back in here, John Edmonds. So since
yeah, they
2010,
never got an
Dodd-Franklin is
agreement
what
on
I
that.
guess they're talked about. Sorry to have cut you off there, John Edmonds.
No, no, go ahead, go ahead.
Peter Koenig, to you, since 2010, as our guest there said, since Dodd-Franklin, but more specifically in the past year or so, when the Fed stepped in to raise interest rates to try to tame inflation. So they've known about this, I'm guessing, in the past year. But now we're seeing the results, or now is the time that we're seeing things unfold. Is that correct, Peter Koenig?
Yes, I would agree with that. And what has actually happened during this long period of low interest rates or almost zero interest rates, you know, the banking system has become laissez-faire, sort of has taken the laissez-faire attitude in terms of lending, particularly, and have not looked very much at the risks because the risks were kind of low with the low interest rates. They didn't risk very much, but they could produce money for the system. As you know, in the U.S., probably more than 95% of the money generated in circulation is made by the private banks by establishing loans, not by the Federal Reserve. So all of that has helped the private banking sector enormously. Now suddenly there is a surge of interest rates, as you said, within the last year or so, to what it is now, close to 5% or something like that. This is enormous from zero within a year. And that, of course, reflects on the lending. This is just for prime lenders. And that has an enormous impact, as I mentioned before, not only on business itself, but also on the banks. And therefore, this is certainly a point that has to be taken into
Okay.
very much into account
Sure.
in the current crisis.
So you have what's going on in the States, and then you have now what has happened basically out or overseas. John Edmonds, taking a look at bank shares that have fallen in Asia and in Europe, of course, stock markets also. But in particular, what seems to be making some noise here is Credit Suisse, where there has been, it's closed down 30%, it's nosedived to a historic low. You have the U.S. Senator Bernie Sanders saying that everybody is concerned about the impact of Credit Suisse problems on the U.S. banking system. And you have the U.S. Treasury officials who are monitoring the problems, and they're contacting their, counterparts. So doesn't that mean that there is exposure? And it sounds like they're not saying something about this, but exposure, I mean that, you know, these banks are related, these financial institutions, banks to their overseas, to the banks overseas. Are we correct in this?
Oh yes, absolutely. They have lines of credit with each other, but also the central banks have lines of credit with each other, and they're constantly in communication with each other. But I wouldn't limit it to Credit Suisse. The two largest banks in Germany have been operating below book value per share for most of the past 15 years, and they make a little bit of money one quarter and lose a little bit the next quarter, but they're not really earning enough to be staying in business. But that's just moving right on. I'd mentioned the Japanese banks, which depended on zero interest rates for the longest time, and interest rates in Japan have been held still in the 1% range, and finally are being allowed to creep up in the 2% range. But even that is traumatic for a country that had effectively 0% interest from 1990 onward. 1990 onward, you could have a very successful career in banking in Japan, allocating money that isn't really costing you anything, and you didn't really have to charge the borrowers very much for the money either. So they could borrow money, and then when it came time to pay it back, they could just borrow some more and use the new money to pay the old money.
Okay.
That's now coming to roost.
Exactly, and that's what we're looking at. And it seems like, Peter Koenig, that this easy money is at the heart of the problem, isn't it? Isn't that the real fact here? But if it's easy money, and they took it, they being the banks, financial institutions, or what have you, why were they not able to generate enough money in order for them not to see the day that we're seeing now? Because from what we understand, the easy money stopped within the past year. Isn't that correct?
I
Peter
would
Koenig.
say within the last 6 to 12 months. That is correct. But you know, this is a very short period of time for the banks to refinance themselves after having been overly exposed and taking many risks. This is a very short period of time, especially since it's the banks themselves who have taken advantage of the low interest rates and created more money by giving more credit to institutions which may have been not the most risk-free institutions or businesses. So I think yes, this is one thing. Then secondly, I don't believe that many people have foreseen what was going to happen in terms of interest rate increases. Yes, we have been told before that the Fed will increase interest rates, and as a consequence, usually Europe does too. And so yes, this was out there, but it has not happened for such a long time, and we were crying wolf for too long. And so eventually, when it started happening, nobody was really prepared.
Sure.
And this is what's playing out today. This is part of what's playing out today. But I would like to come back to the other factor with which we started, and the derivatives, because we have also publicity. You know, we have the media that say anything they are paid to say. And if they make propaganda with the overextension on derivatives of the banks, that has an immediate impact, maybe not on the the small consumers, but on businesses. And if we look at these, and of course these big banks, they know that. If they have a quadrillion outstanding, I don't know exactly, nobody knows the figure, but let's put it that way. A quadrillion is about 10 times more than the current world GDP. Can you imagine? A quadrillion of casino money compared to created money with the world's GDP. So if that floats out, you have an enormous for this kind of angst created, and people may actually not just run the banks for their cash, but banks also may start running other banks for their outstanding derivatives, and that creates a
Well, sorry to jump in because we just have a minute left here, and I'd like to go to you, John Edmonds. So whatever happened to the U.S. President Joe Biden? Words of assurances didn't really pan out, did he? Did it? I mean, he said, one of the quotes, "No losses will be borne by the taxpayers." Let me repeat that: no losses that the taxpayers have to pay. But at the same time, we know that some of the bank fees obviously play into that the taxpayers will have to pay for it. But he's not making that much of a dent in the sentiment out there. And final question to you, John Edmonds. How are you and your friends feeling about this? I'm just wondering, generally speaking, the American public, are you guys thinking we should take our money out of the bank? Is that the general sentiment?
Well, some do, but I personally am not worried at all because of what Joe Biden said. That is to say, there are guarantee funds in existence that can buttress the banks. This was a guarantee fund that was created in the 1930s called the FDIC, and then a second one which came out of Dodd-Frank, and that part did work. But still, I think it is correct that the taxpayers ultimately will suffer if there's any economic downturn. They would make less money, but they wouldn't be on the hook definitely for bailing out a bank. And specifically, bank executives will not walk away from this with enormous severance packages. I really don't expect that. This will be different in that regard.
Thank you very much. We're going to unfortunately have to end in there. John Edmonds, Professor of Finance at Babson College in Wellesley. Thank you. Peter Koenig, former World Bank economist from Lima, Peru. Thanks. With that, we come to an end for this edition of The Spotlight from Ika Watawe and the team. It's goodbye.